Algoma Steel Group, Inc., ticker symbol ASTL on the NASDAQ and TSX, just dropped their Q2 2026 earnings print.
And we need to get right into these numbers.
Yeah, we do. So adjusted EBITDA came in at $13.8 million, which is exactly in line with management's previously announced expectations.
Right, they hit the target.
But consolidated revenue was $267.5 million. And that is a massive drop from the $589.7 million they reported in the prior year quarter.
I mean, they basically cut the top line in half.
Literally. On the bottom line, earnings per share showed a net loss of 88 cents per share. But that is actually an improvement from the net loss of $1.02 per share in Q2 2025.
Which is an interesting twist, yeah.
And looking ahead, their guidance indicates that electric arc furnace unit 2 is nearing completion. First steel is expected in the third quarter of 2026.
And maybe the most important forward-looking metric, excess capacity utilization costs, are projected to drop to 0 by Q4 2026.
Okay, let's unpack this. Because if you are a retail investor looking at this specific earnings report, the immediate question glaring back at you is this: how exactly does a company cut its revenue by more than half, fundamentally slash its top line, yet still manage to hit its adjusted EBITDA target and actually improve its earnings per share?
I mean, it looks like a complete mathematical contradiction on the surface, doesn't it?
It makes no sense at first glance.
But to make sense of these numbers, you have to realize that you are not looking at a normal operating quarter, like at all.
Right.
You are looking at a company executing the absolute final phase of a complete forced operational overhaul. That massive revenue plunge from nearly $590 million down to $267.5 million. It isn't a failure of their sales team.
No, it's not a demand issue.
Exactly. It is the deliberate mathematical result of permanently halting their legacy blast furnace operations on January 18th, 2026.
Right. And just so we are all on the same page, help me visualize what that actually means on the factory floor. Because shutting down a blast furnace isn't, like flipping a switch on a warehouse, right?
Not at all, no. A traditional blast furnace is a massive, continuously burning beast. You feed it iron, ore, and coal, and it basically has to run 24/7 to remain efficient.
Because if it cools down, you have major problems.
Yeah, the fixed costs are astronomical, and you can't just turn it off for the weekend without severely damaging the internal refractory brick.
Wow.
So when Algoma made the decision to halt that legacy furnace in January, they were permanently killing their old high-volume engine. They have completely turned that off and are pivoting exclusively to a ramp-up of their new electric arc furnace platform, or EAF.
And an EAF operates very differently.
Totally differently. An electric arc furnace doesn't use iron, ore, and coal in the same way at all. It uses massive electrical currents to melt down scrap steel.
Like a giant recycling belter.
Yeah, exactly. It's far more flexible, and you can actually modulate production. But here is the catch for this specific quarter. In Q2 2025, they were producing steel exclusively from that massive old blast furnace at full tilt. But in Q2 2026, every single drop of liquid steel was sourced from their first EAF unit, which is still in its ramp-up phase.
So they're bottlenecked?
Precisely. The top line is cut in half simply because their physical production capacity is currently in a massive transitional bottleneck.
So it's less about a loss of market demand and entirely about a self-imposed supply constraint while they rebuild the factory floor.
Exactly.
But let's look at the unit economics here, because the volume drop you're talking about is just staggering when you look at the raw data.
It is a steep drop, for sure.
Yeah, Q2 shipments plummeted by 61.6%, down to just 181,473 tons. If you're holding this stock, seeing a 60% drop in volume is the kind of thing that triggers immediate panic selling.
Right, and that is exactly why we need to dig deeper into the margin details, because volume is only half the revenue equation.
Okay, what's the other half?
The crucial offsetting metric here is the pricing power they commanded on the steel they actually did manage to sell.
Oh, you mean the average net sales realization per ton?
Yes. It actually jumped 20.2% to $1,361.
Wow.
Yeah, that is a massive premium compared to the $11,132 per ton they were getting a year ago.
That's a huge jump. Why the sudden premium?
Well, management attributes this directly to a richer product mix under what they're calling their plate-first strategy.
Which we should definitely dig into later.
Oh, absolutely. But strictly from a margin perspective right now, they are selling far less steel, but they are selling it for significantly more money.
Right. But we also have to look at what it costs them to make that steel. And this is where the transition pain really shows up in the income statement.
Yeah, it gets a bit ugly here.
It does. The cost per ton of steel products sold was $1,411.
Right.
So they are selling it for $1,361, but it costs them $1,411 to make. That is fundamentally a negative operating margin per ton.
Mathematically, yes.
They're physically losing $50 for every ton of steel that leaves the facility right now.
Which brings us to the accounting adjustments. The report points out that this negative operating margin is primarily due to lower fixed cost absorption at reduced production volumes during this EAF ramp-up.
Okay, and that brings us to the $54.7 million capacity utilization adjustment they added back into their adjusted EBITDA.
Yes, that's a key line item.
I want to use an analogy here for you, the listener, because this specific accounting term can be incredibly confusing if you just read it on a spreadsheet. It's like you are moving apartments.
That's a really good way to look at it.
Right, so for a couple of months, you are paying rent on two different places at the exact same time.
Yep, the dreaded double rent.
Exactly.
Yeah.
You've got the lease on the new place you are moving into. That's the new EAF platform. But you are still stuck paying for the excess fixed costs of the old place.
The labor, the equipment leases.
Right, all the legacy asset maintenance of the old blast furnace configuration that you can't quite walk away from yet. You are carrying two heavy loads while only living in one apartment.
That is the perfect way to visualize it. That $54.7 million represents the excess fixed costs carried beyond what was actually required to operate the EAF at the volumes they produced this quarter.
It's the dead weight of the transition.
Exactly. When you are running a giant steel mill at a fraction of its capacity, your cost per ton skyrockets because those massive fixed costs are spread over far fewer tons of steel.
So here is my pushback as an analyst looking at this report.
Let's hear it.
If they are technically losing money per ton right now on a fundamental physical operating basis, and they are magically adding back $55 million in these two apartment transition costs to make the spreadsheet look better, how legitimate is that positive 5.2% adjusted EBITDA margin they are reporting?
That's the million-dollar question.
Right. Is it a true reflection of the underlying business, or is it heavily massaged accounting?
Well, what's fascinating here is that the positive adjusted EBITDA of $13.8 million was heavily buoyed by a completely non-operational one-off event.
Wait, really? It wasn't just the capacity adjustment?
No, it wasn't just the capacity adjustment holding them up. During the second quarter, Algoma and its insurers reached a full and final settlement of $145 million.
Wait, an insurance settlement? From what?
A structural utility corridor collapse that happened back in January 2024.
Wait, so their financial lifeline this quarter is literally a payout from a collapsed building that happened 2 years ago.
Exactly. Out of that total $145 million settlement, $45 million was recognized in other income this quarter, and that drops right down into the adjusted EBITDA calculation.
Okay. That changes the picture completely.
It really does.
So without that $45 million insurance injection falling from the sky, the operational reality is still deeply supply pressured and unprofitable on an EBITDA basis.
Precisely. Without the insurance settlement, you are looking at a fundamentally negative EBITDA quarter.
Wow.
But, and this is the forward-looking bright spot you have to model in if you're an investor, those two apartment excess capacity costs are dropping rapidly.
Because they are finally getting out of the old lease, so to speak.
Right. In Q1, that capacity utilization adjustment was a massive $90.2 million.
Okay.
In Q2, it dropped to $54.7 million. And management explicitly stated that these costs are expected to decline further over the next 3 months and be fully eliminated by the fourth quarter of 2026.
So the dead weight is falling off the balance sheet exactly on schedule.
Exactly, as they fully decommission the old blast furnace assets.
Okay, so they are bleeding cash on the transition, but they have a clear tourniquet applied that tightens to zero by Q4.
That's a good way to frame it.
So they are surviving on an insurance payout and debt just to make it through this near-death experience. Which begs the question, why put yourselves through this massive disruption in the first place?
Right, why endure the pain?
Because this massive operational shift to the EAF wasn't just some benevolent environmental initiative, right? Yes, the report highlights that the new Volta brand of EAF steel will reduce annual carbon emissions by roughly 70% from pre-EAF levels.
Which is great for marketing and ESG scores, sure.
Yeah, but this transition was fundamentally a matter of corporate survival, dictated by geopolitical trade winds.
That is a critical point for retail investors to understand. This entire EAF transformation was dramatically accelerated by an unprecedented 50% U.S. Section 232 tariff.
And as financial analysts, we need to remain completely impartial here. Our job isn't to debate the politics of cross-border trade policy.
No, absolutely not. Our job is to measure the financial blast radius of those policies on the companies we cover.
Right. We are just looking at the math.
Exactly. And the financial reality, as explicitly cited by Algoma's management in this report, is that this 50% tariff fundamentally altered and permanently disrupted their historical cross-border business model.
It effectively foreclosed their traditional access to the U.S. market.
It really did.
And the numbers on that are just brutal to read. Historically, Algoma's shipments to the United States represented anywhere from 45 to 55% of their total steel shipments.
Half their business went south of the border.
Yeah. In Q2 of last year, it was 54% this quarter. It dropped to just 23%.
That is a massive retreat.
They have intentionally retreated from the United States.
Yeah.
But by doing that, they drastically reduced their financial bleeding. Algoma cut its direct tariff costs from $64.1 million in the prior year quarter down to just $18.7 million this quarter.
They simply stopped shipping over the border to stop paying the massive penalty.
Exactly.
Which forces a massive strategic pivot. Think about it. If you lose half your historical customer base overnight because of a tariff, what do you do with all that steel?
You have to find a new buyer.
Right. Which brings us to CEO Rajat Marwah's strategic response, the Canada-centric plate-first strategy.
Okay, here's where it gets really interesting. Because I'm looking at this plate-first strategy, and honestly, at first glance, I just don't get it.
Why not?
If they lost the U.S. market, why aren't they just selling the exact same steel they always made, but just selling it in Canada? Why change the product entirely?
Well, because the Canadian domestic market right now is an absolute mess for standard steel. It is heavily supply pressured.
How so?
The report notes that domestic coil pricing is being held down by severe oversupply.
Coil being the standard thin sheet metal that gets rolled up.
Exactly. Coil is a commodity. You use it for car bodies, appliances, basic manufacturing.
Okay.
But right now, you have Canadian producers who are displaced from the U.S. market dumping their coil product domestically because they have nowhere else to put it.
So everyone is crowding the same local market.
Yeah, and you still have U.S. steel entering Canada, plus you have import offers from overseas priced at less than fair value.
So it's a race to the bottom on price.
A brutal race to the bottom.
Which brings me back to my question. Since the domestic coil market is flooded with cheap displaced steel, is Algoma's strategy to become the sole domestic supplier of discrete plate a brilliant economic moat? Or is it just a forced retreat masquerading as a master plan?
Honestly, it can be both a forced retreat and a brilliant moat.
Okay, explain that.
Think of domestic coil like generic store-brand bread. Anyone with a basic bakery can make it, and the market is flooded with cheap imports.
Okay, I like that analogy. So what is discrete plate?
Discrete plate is like a custom multi-tiered wedding cake. It's highly specialized. We are talking about incredibly thick, heavy-duty steel used for armor, submarines, bridges, and heavy machinery.
So not just standard sheet metal.
No, not at all. It requires highly specialized rolling mills that competitors simply do not have. And because Algoma is the only bakery in town with the equipment to bake it, they can charge whatever they want.
Ah, so they literally have a monopoly.
Yes. They are Canada's only producer of discrete plate.
Wow.
So you answer your question about whether this is a master plan by pointing directly to the earnings proof. Algoma just delivered a second consecutive quarter of record plate sales.
So the demand is there.
Huge demand. They are funneling their limited transitioning EAF production capacity specifically into discrete plate, serving infrastructure, construction, and defense end markets.
That is smart.
By focusing there, they enjoy a massive pricing premium, which completely explains that 20% jump in average realization per ton we discussed earlier.
Right. The $1,361 per ton.
Exactly. They have successfully sheltered themselves from the oversupplied, highly competitive domestic coil market by hiding behind the walls of their discrete plate monopoly.
Okay, that makes total sense now. They can't compete on volume anymore, so they are pivoting entirely to high-margin specialty products where literally no one else in the country can compete with them.
It's a survival tactic that turned into a huge advantage.
So if they have successfully retreated to this highly specific Canada-centric niche, The final piece of the puzzle for you, the retail investor listening to this, is evaluating how this company plans to secure long-term demand for that niche.
You have to secure the buyers.
Right. How do you ensure the infrastructure and defense sectors keep buying your specialized plate while you manage your cash burn through the end of the transition?
Well, management is actively trying to manufacture that domestic demand themselves.
What do you mean?
On April 7th, 2026, they announced the formation of Rochelle Algoma Defense Solutions. This is a joint venture with Rochelle Inc., which is a Canadian-owned defense manufacturer of armored vehicles.
Oh, so they're vertically integrating.
Exactly. The goal of this JV is to support the development of domestic ballistic steel and related manufacturing capabilities right there in Canada.
So they are locking in their own customers.
Yes, they are partnering directly with defense contractors to guarantee a reliable buyer for their high-margin EAF plate.
But there are massive execution risks when you rely on government infrastructure and defense spending to be your primary customer.
Oh, absolutely. It's not a sure thing.
You are dealing with slow bureaucracies and heavily politicized procurement processes, and the earnings report actually spells one out clearly.
Yeah, the submarine project.
Exactly. Back in January 2026, Algoma announced a Memorandum of Understanding in OU with Hanwha Ocean for the Canadian Patrol Submarine Project. But in this report, they disclose that the MAU has been suspended.
Yes, that was a pretty significant blow to their forward-looking narrative.
And why was it suspended? Because on July 6th, the Government of Canada announced that a competitor, ThyssenKrupp Marine Systems, was selected for the submarine procurement process instead.
So the whole deal fell through.
Right. Hanwha lost the bid, which means Algoma lost the contract to supply the steel. So how should a retail investor price in these binary win-or-lose government contracts? Because when they lose a bid like the submarine project, that is a massive chunk of future demand that just vanishes into thin air.
You know, you really don't price them into your base case, period.
You just ignore them.
You treat them as upside optionality. If they win the contract, great, your stock gets a bump. If they lose, it shouldn't destroy your core valuation of the company.
That's a solid way to look at it.
If we connect this to the bigger picture, the real metric retail investors need to obsess over right now isn't the pipeline of unwon government contracts. It is pure liquidity.
Can they survive the valley of death?
Exactly. Can Algoma survive the valley of death between shutting down the blast furnace in January and fully ramping up the twin EAF units by the end of the year?
Right. And what does the balance sheet say?
The balance sheet says yes. At the end of June 2026, Algoma had $437 million in total available liquidity.
Well, let's break that $437 million down, because that's not all just cash sitting in a checking account.
Right, no. That includes $62.6 million in actual cash, plus over $206 million unused on their revolving credit facility.
Which is basically a giant corporate credit card they can tap into if things get tight.
Exactly. And they also have $168 million available to draw under their governmental loan facilities.
Okay, so they have a lot of runway. And we also see the cash drain slowing down on the capital expenditure side.
The heavy spending is mostly over.
Right, with EAF Unit 1 already running and Unit 2 nearing completion, their CapEx has dropped significantly. They were spending $97.4 million in Q2 of last year. It is down to just $29 million this quarter.
So they are past the peak construction spend.
And more importantly, they received $124.5 million in new governmental loan advances this quarter, specifically to bridge this gap.
Which is a huge vote of confidence.
It really is. That tells me the government has a vested interest in making sure Canada's only plate producer doesn't go bankrupt during the transition.
Exactly. The ultimate takeaway for the retail investor here is that management is highly focused on disciplined cash management.
Yeah, they are pulling every lever they have.
They are using government loans, drawing down the heavy capex, and relying on fortuitous insurance payouts to keep the lights on and the balance sheet stable.
They just need to survive the next 2 quarters.
That's it. Once Unit 2 is pumping out first steel in Q3 and those legacy excess capacity costs hit zero in Q4, the entire financial profile of this company resets.
It's a completely different company at that point.
You go from a company bleeding cash on 2 apartments to a streamlined, lower-carbon EAF producer with a monopoly on domestic plate.
So what does this all mean when we put the pieces together? You have a company that lost half its revenue, is physically losing money on every ton it pours purely due to temporary fixed costs, but is successfully masking the bleeding with a massive insurance settlement and a brilliant strategic pivot into a niche plate monopoly to avoid a disastrous tariff.
It means we are watching a massive corporate survival story play out in real time.
It really is incredible to watch.
But, this raises an important, much broader question for you to ponder as an investor. Algoma entirely changed its manufacturing process, slashed its product mix, and abandoned its primary export market almost entirely due to a single 50% cross-border tariff.
One policy change did all that.
Exactly. It begs the question, how many other foundational North American supply chains are currently being quietly, fundamentally rewritten in the background of our economy without the end consumer ever realizing it?
It's a fascinating thought. The heavy industry map is being redrawn, and Algoma is just one node on it. If you want to cut through the noise and get straight to the numbers that matter, make sure you follow the deep dive for daily earnings coverage.